So I have heard rumors that this company, Seritage Growth Properties, may be trading at or even below liquidation value. So going into this, we fully expect that there's going to be a liquidation value analysis here, which frankly don't show up very more often, at least not when I'm looking. Maybe some people would disagree, but I look pretty hard to find these very, very cheap companies. I don't always find them. As we're following up on the rumor, this is going to be the 43rd, yes, 43rd company in the 2022 season. Our Sage Seeds AI is going to put a value rank at the end of the video. Try to guess whereabouts the ranking of Seritage Growth Properties is going to be. If you'd rather skip ahead to see the ranking, then come back, feel free to do so with the timestamps in the description. In general, all my videos are designed to be navigated as you please. Let's dig into these numbers so that your wisdom can blossom. Even though I'm excited about the liquidation value rumor, we're not going to look at any of that stuff until we've done the opening move of going to the item 8. It's really good to always stay consistent. It can easily get confusing if you don't stay consistent. The item 8 was added in the appendix. We've seen this before together. This usually means that there was some disagreements between the auditor and the company. It doesn't have to, though. It could be anything from a filing error to what I just mentioned. Let's find it, though. The issue that the auditor is raising is that the way impairments, so devaluations compared to a previous time, of real estate investments specifically. Now, this is a real estate company. It's called Seritage Growth Properties. And so this is a pretty bad deal that this is probably going to be like the main thing that they do is own real estate properties and share how valuable they think those properties are. For the auditor to be saying that that's something that they disagree with is kind of a bad deal. Okay, let's see this balance sheet. As we do expect, there are a lot of investments in real estate. That is most of the balance sheet. Everything, really all of this, about half of all the assets are just different types of real estate investments, which I appreciate that they're giving us the detail here. Both land and buildings and improvements have decreased substantially. Now, this could be impairment, but for this shift, this might even be selling of property. You might want to clarify whether this company, this real estate company, is actually selling off real estate already. Total debt is about $1 billion. Let's definitely remember that because that's a big part of the liquidation value calculation. And yes, this company for a while has been building an accumulated deficit rather than retaining earnings. Going to the statement of operations, the income statement, rental income actually didn't decrease that much considering how much property and land decreased in the balance sheet. And that's kind of interesting. Total expenses of almost 190 million, whereas rental income is just above 100 million. I mean, that's a big gap. Here is confirmation that a big chunk of that change in the balance sheet was them actually actively selling real estate. And interest expense, this is confirming the rumor that I was seeing, is sometimes higher than all of rental income. They have kept it below rental income in the most recent period, but it's 86, almost 87 million. When remember, their raw revenue is just above 100 million. And there's like an extra 90 million that they're having in expenses. Not a great situation. Let's do our due diligence in the statement of cash flows. The gain on sale of real estate is not a cash gain, and so they didn't actually receive cash for this. We're probably going to go directly to trying to figure out the liquidation value of this thing. Whether this is explained as a cash or non-cash expense will only be a small part of the calculation. There's better places to spend our time, in my opinion. Someone's getting share-based compensation even in these situations, although they did have negative share-based compensation, which I almost want to ask a question about that. But again, let's save our energy, save our time. There's some subsidiaries, they call them unconsolidated entities, that are kind of significant actually, and it seems to be a recent thing, so I'm not 100% sure what's going on here. Very first note here, it caught my eye. It's called organization. This is a bit of an unusual asset to value because it is a real estate investment trust, a REIT. REITs generally do the same sort of thing. They're a holding company that just collect rental income and have management expenses. That's the core gist of it. But there's not actually a lot of requirements that they need to do that. And so it probably would be good just to see if there's anything funky about this REIT in particular. It might just help us simplify the liquidation value calculation or alert us of anything that we should be aware of that wouldn't be simple. Company was formed in 2015 as a real estate investment trust. Seritage's assets are held by, a Delaware limited partnership. Under the agreement, Seritage has exclusive responsibility and discretion in the management and control. Prior to the adoption of the company's plan of sale, very accurate rumor, I guess, the company's portfolio consists of interests, so not full ownership necessarily, but interests in 97 properties, approximately 13.5 million square feet of leasable area, 157 acres held for or under development, so 157 just raw land acres. Company commenced operations following the rights offering to the shareholders of Sears Holding Corporation. I actually remember this, so I know this company. I don't remember it was called Seritage. They must have changed its name. But back in 2015, I was very much following up on the liquidation of Sears Holding Corporation. I mean, Sears used to not own any of its stores. It used to lease them from a separate entity, which was this Sears Holding Corporation. This is where they went. And so a lot of these properties are what were previously Sears stores, plus the other things that they were dipping their toes in. That's wild. I had no idea I was going to see this again. Forgot about this. I'm feeling nostalgic right now. There's throwback. So the company sought a shareholder vote to approve the proposed plan of sale. The plan of sale was approved. The strategic review process remains ongoing as the company executes the plan of sale. There can be no assurance that the review process will result in any transaction or that the company will be successful in fully executing the approved plan of sale. Then there's a section about liquidity. Let's also look at this. There's no point in doing a liquidation value calculation if the company already knows it's going to burn most of those assets before it even gets to sell. So the company's primary use of cash include the payment of operating expenses for properties. Property rental income, which is the company's primary source of operating cash flow, did not fully fund obligations in the last year. We saw that there was about a 90 million deficit. Additionally, the company generated investing cash inflows, but that was from the previous asset sale, so let's not count that. So they have until 2025 to pay off 800 million. They did need to sell 18 of those 97 properties, and so they're actually down to about 80 properties now. Continuing down into the notes, we have a section called real estate disposition. Let's try to understand it together because it's supposed to be quite helpful. They're explaining that when the company disposes, aka creates a disposition, it recognizes a gain or loss as the difference between the carrying value, so what's already listed as an asset on their balance sheet before the sale, and the money received, which could be higher or lower, which is why there is either a gain or loss. In certain circumstances, they don't just receive cash, they also receive shares in unconsolidated entities, and that explains earlier. So it's not really subsidiaries that they were collecting some revenue from. They sometimes collect equity instead of cash when selling a property, and so they continue to receive a little bit of rental income. They just are no longer the owners of those unconsolidated entities. That's helpful. They've actually been selling hundreds of millions of real estate properties for years now. So as I've been continuing to explore these notes, I've come to realize that the land and real estate is not as valuable as what is listed on the balance sheet. On the balance sheet, it's listed at around 200 to 300 million. And the reason I'm being so nonchalant about that is that would not necessarily be enough to cover the debt, which is 800 million. You would be at a loss there. Very, very strange, because almost always when you're looking at a REIT, you want to look at the properties that it owns. But what's happened here is that this company got a lot of properties, a lot of land from what used to be Sears Holding Corporation. That land has not become profitable. Those buildings have not become profitable under management of Seritage. However, they've been opportunistically selling specific parts of the portfolio, always having a preference not to receive cash, but to receive equity in what they're calling unconsolidated entities. This is something funky that is not necessarily the most common, but that they're very, very focused on. Their ownership in other REITs and other real estate investment trusts is actually the bulk of what their liquidation value should be. Hey, if you're getting more comfortable uncovering the stories behind the numbers, please like and subscribe. Here they've listed 8 investments. These are the investments. These are who they are partnering with. And so in the case of this first one, GS Portfolio Holdings 2, it was not profitable buildings under Seritage, but Seritage was handling all the management expense. Now they own 50% of these 2 properties, but Brookfield Properties Retail is managing it, having the management expense. Whatever profit is left after Brookfield manages, Seritage gets 50% of the profit. Now, the collection of these 17 properties in 8 different unconsolidated entities, as they called them, is 1.4 billion, which would on its own cover the 800 million in debt and leave about 600 million before we consider that Seritage still has several properties, about 80 properties, which aren't profitable at all right now, but that they might be able to opportunistically sell in this way as well. Now, that's a big if, but that's clearly the plan that they're having. The operating expenses then that we saw, which were so much higher than rental income, should be thought of as the minimum in order to keep these properties with the potential to sell to a joint venture partner that will be able to make them profitable. And so Seritage, for whatever reason, isn't able to make these properties profitable. Most real estate investment trusts exist solely to be the managers. Seritage really doesn't seem that interested in doing that. They seem interested in keeping the properties around until they find another trust that is going to be the right owner and allow Seritage to maintain ownership of at least 31% here, but most of the time it's been 50% so far, 50% ownership. Ownership of the profits from these buildings after the joint venture partner manages them and has expenses to manage them. And so this would be ownership of profit. Now we could quickly do some rough math here and be like, if they continue to find deals like this, they have about 80 properties left. This would very much be in the billions of dollars. However, I will stress right away that these were the first easy sales. It's very unlikely that they're going to find opportunities to unload properties that are as good as this. This is probably about as good as it's going to get. Let's say they only do half as well in order to unload the other 80 properties that they have roughly. Is half a conservative enough assumption that they'll be able to get half as good of a deal in the future for the rest of their portfolio? Maybe that's not enough. Honestly, I would take that to be even more conservative. But with that, decently conservative, at least, assumption, we're looking at 3-4 billion in the value of these unconsolidated entities. That's roughly what we're talking about when we say liquidation value in this case. And it really boils down on some not necessarily risk-free assumptions, such as there's 80 properties left. Are you going to find enough joint venture partners that are going to be able to actually do things with those 80 properties? It's great that they sold 17 out of around 97 properties, but why didn't they sell more than 17? They've clearly been focused on trying to do this for at least a couple years. Why are 80 properties still not sold? Has anyone been able to guess the rank of this real estate investment trust that's not interested in managing real estate investments? Weird situation, not an easy thing to value. I'm excited to see what the Sage Seeds AI has to say. Please like, subscribe. Does anyone out there collect rent from something or know anyone who owns an apartment that they rent out? Being a landlord always surprises me how the person you least expect will just randomly be a landlord to someone. Now, of course, we're talking about real estate investment trust. We're talking about an industrial level of being a landlord. That's a bit less, obviously that's less common. But I love the hustle when someone gets an apartment or rents out an extra room. That stuff actually I see happening more and more, and good on everyone who does it. Be a good landlord. Be nice to your tenants. Share your stories, share your wisdom, share this video. Rank 35 out of 43 in value for the 2022 season. Now, fairly low ranking, actually the same ranking that GitLab received not that long ago. Check out the GitLab video, although it's a very different sort of business. What's going on here is that the AI seems to be picking up on the fact that liquidation value is going to be eroded every month that Seritage is managing these 80 properties. So Seritage is playing against the clock right now, burning tens of millions of dollars managing properties that are not profitable. It's been trying for years, only been selling a couple dozen properties off over the last 3 years that we were seeing in the annual report. This could be many more years left, and again, you're burning tens of millions of dollars until that happens, with basically just the properties as your downside protection. There is risk. As excited as I was getting seeing the billions come up, and as I hope other people should get excited if they want to look into it deeper and then share with our community in the comments. I don't know why you would do that, but please do if you do. The AI is taking us to a cautious place, but that doesn't mean that there isn't hidden value here. The AI is going to be the first to understand that it's in an opportunity like this one. What you really want to understand is the communities and the locations of the property. You really want to become a bit of a real estate expert in order to unlock the full potential of this liquidation value calculation. What Sage Seeds is saying is be cautious though, because the underlying commitments and finances of this business, even if they are great properties, certainly do not paint a picture of a low risk investment.